What if the greatest threat to your financial future isn't a stock market crash, but your own desperate need to feel safe? We spend our lives chasing a ghost, a portfolio so secure, so stable, that we can finally sleep well at night. It's the holy grail of investing, a promise whispered by financial advisors and splashed across headlines. It's a simple idea. Build a fortress of safe assets, and you'll be protected from the chaos of the world. But this promise is built on a dangerous misunderstanding of what risk truly is. It pits two of our deepest desires against each other: the longing for security today versus the necessity of growth for tomorrow. This conflict creates a paradox where the very actions we take to protect ourselves can become the instruments of our own financial ruin. For most people, the concept of risk is simple. It's the scary red numbers on a screen, the gut-wrenching drop in their account balance. But there are quieter, more insidious risks hiding in plain sight. The slow erosion of inflation, the silent thief of opportunity cost. To understand this, we have to look beyond the spreadsheets and into the flaws of our own psychology. For instance, there is a concept known as loss aversion. This is the well-documented psychological principle that states the pain of losing $100 is far more powerful than the pleasure of gaining $100. It's an evolutionary glitch in our programming. In this video, we're going to deconstruct the myth of the sleep well at night portfolio. We will not be giving financial advice, but instead, we will explore the psychological traps that shape our decisions, expose the hidden dangers of playing it too safe, and redefine what it actually means to build a resilient financial life. Because the goal isn't just to sleep well tonight, it's to ensure you can afford to wake up in 30 years. Most people believe a sleep well at night portfolio looks something like this: a heavy allocation to government bonds, a basket of blue-chip dividend-paying stocks from companies that have existed for a century, and maybe a sprinkle of gold for good measure. Think of the classic 60-40 portfolio: 60% stocks, 40% bonds. For decades, this has been the bedrock of conservative financial planning. The logic is sound, or so it seems. When stocks zig, bonds zag. It's a simple, elegant machine designed to smooth out the ride, to dampen the terrifying volatility of the market. It's a strategy built not to win, but explicitly not to lose. It's the investing equivalent of a defensive crouch, prioritizing capital preservation above all else. Countless retirement plans are built on this very foundation. The financial world presents it as the responsible adult choice. But if this strategy is so prudent, why do so many people who follow it find themselves falling behind? If it's the answer, why does it feel like the math doesn't add up over the long run? Here lies the first crack in the foundation. The strategy assumes that the greatest risk you face is a market downturn. But what if that's not true? What if the volatility you're so afraid of is not the risk itself, but merely the price you have to pay for the one thing you actually need: growth? To understand this, we have to look at the portfolio through the lens of behavioral economics. The 60-40 portfolio, and others like it, are not purely financial instruments. They are, first and foremost, psychological tools. They are engineered to cater to our deep-seated loss aversion. As we said before, our brains are wired to feel losses twice as keenly as we feel gains. A 10% drop in our portfolio causes us more pain than a 10% gain brings us joy. This portfolio, then, is designed to minimize that pain. It's a sedative for our anxious, primitive brain, which can't tell the difference between a stock market correction and a saber-toothed tiger. And here is our first real revelation. The sleep well at night portfolio was never truly about optimizing your finances. It was about tranquilizing your emotions. It's a brilliant solution to a psychological problem, but it might be a terrible solution to a mathematical one. We've been so focused on avoiding the emotional discomfort of short-term losses that we've ignored the silent, catastrophic risk that was growing in the shadows. But this emotional tranquilizer has a devastating, slow-acting side effect. If market volatility is the loud, obvious monster, inflation is the silent, invisible poison. If everything we've said is true, that this portfolio is designed to protect us from sharp, painful drops, then it leaves us completely exposed to the slow, certain decay of our purchasing power. Consider this. For the last 50 years, the average rate of inflation in the United States has hovered around 3.9%. At that rate, the value of your money gets cut in half every 18 years. The $100,000 you so carefully protected in safe, low-yield assets will only buy you $50,000 worth of goods and services by the time you're ready to retire on it. This is the portfolio's fatal flaw. The very thing that helps you sleep at night, its stability, is the very thing that guarantees it will fail over the long term. The fortress you built to protect your wealth is actually a prison, preventing it from growing faster than the forces that are actively destroying it. The strategy designed to avoid the risk of a sudden crash actively embraces the certainty of a slow, grinding decline into irrelevance. This fundamentally changes our entire line of questioning. The dilemma is no longer about safety versus risk. It is now about choosing your risk. Are you more afraid of the visible temporary pain of a market correction, or the invisible permanent pain of your life savings losing its power year after year? If the fortress is a trap, then what were we really trying to build in the first place? To answer that, we have to go to the source of our fear. The feeling of watching your portfolio drop 20% is visceral. It's not an intellectual exercise. It's a punch to the gut. Your lizard brain, the part of you that evolved over millennia to react to immediate threats, screams, "Danger! Sell! Run!" It doesn't understand compound interest, but it understands scarcity and loss. This panic is a powerful force. Historically, it's what drove people during the Great Depression to pull their money from banks and hide it under the mattress. It was a perfectly rational response to their immediate environment. But that same behavior, that deep-seated fear of institutions and markets, caused that entire generation and the next to miss out on the greatest economic expansion in human history. Their desire to avoid repeating the pain of the past blinded them to the opportunities of the future. The safety of cash under the mattress became its own kind of risk, the risk of being left behind. But I know what you're thinking. What about people who are already in retirement? They can't afford a 30% drop. They need that capital to live on. Their priority must be preservation. That argument seems to refute everything we've discussed. It's the single strongest case for the sleep well at night portfolio. But let's deconstruct that idea of safety. Is a retiree truly safe if their portfolio is generating a 2% return while inflation is running at 4%? Every year they are falling behind. Every year their ability to pay for healthcare, housing, and food diminishes. Their portfolio isn't preserving their lifestyle. It's guaranteeing its decline. What seemed like their greatest virtue, the preservation of capital, was, in fact, a bet against their own longevity. They were implicitly wagering that they wouldn't live long enough for inflation to become a serious problem. The ultimate risk for a retiree isn't a market crash they can recover from. It's the risk of outliving their money. And a portfolio that doesn't grow is a portfolio that is guaranteed to die. The apparent safety was just a mirage. Even their greatest act of prudence was, in reality, their greatest gamble. So we see the full mosaic. We start with the simple myth of a safe portfolio made of bonds and blue-chip stocks. We then realize it's an emotional tranquilizer designed to soothe our loss-averse brains. But we discover that this very stability exposes us to the slow, certain death by inflation. We see how our primal fears, like those of the Great Depression generation, can lead us astray. And finally, we dismantle the ultimate counter-argument, the retiree's need for safety, by revealing that true safety is not the absence of volatility, but the presence of growth that outpaces the erosion of time. The breaking point for any investor is the terrifying realization that their safe strategy is a sinking ship. They've been so focused on avoiding the storm that they never noticed the hull was rotting away beneath them. Now that we understand the psychological machine that drives us toward this illusion of safety, the critical question remains: What does a portfolio that accounts for both the logic of the market and the irrationality of our minds actually look like? The answer low changes everything.